During global financial crisis, American Express's share price fell nearly by 80% from its peak in 2007 through to its trough in March 2009. The business did not disappear overnight. Its customer base did not vanish, and its brand strength did not evaporate over time. But the fear dominated markets. The real question that serious investors asked was not why are share prices collapsing, but the real question was, has the intrinsic value collapsed by 80%? Because it is that distinction that creates or eliminates future investment opportunities. Today in Signal episode 26, let's look at one of the most powerful investment concepts, intrinsic value. Welcome back to Signal, where noisy markets meet simple, sharp, and sound insights for long-term investors. Intrinsic value, in simple terms, is what a business is worth today based on its earning power its activities can generate over time. And that earning power, when translated into economic value, becomes its intrinsic value. In other words, intrinsic value is a business's worth today, irrespective of what market is currently paying for it, because market prices move quickly, but businesses' value moves slowly, and it is in between that difference opportunity lies. Mathematically, intrinsic value represents the present value of a company's future cash flows. But in practice, this concept is estimated using distinct approaches like discounted cash flows, return on capital, earnings, each built on different assumptions. Hence, the valuation produced is in a range rather than a single precise number. For instance, recent valuation models place American Express's fair value or intrinsic value roughly between 380 to 393 US dollars, depending on the method and underlying assumptions. Now let's apply the logic. If the market price is below its intrinsic value range, or in this instance less than $380, it represents an opportunity. It's like finding a quality item on your shopping list available at a genuine discount. If the market price is above that range, say in this instance above 393, then discipline suggests patience. Observe, hold, or trim depending on your position. And if the market price is within the intrinsic value range, say in this instance between 380 and 393, then there is no clear edge. You may either wait or reallocate your capital elsewhere. Experienced investors do not chase price. They patiently wait for value because they know that over time, price converges towards its intrinsic worth or value. So what does this mean for investors? For direct equity investors, intrinsic value acts as a compass. It provides a logical benchmark to answer critical question. Is this correction fundamental or emotional? And that distinction provides you the conviction whether to buy, to hold, or to exit. It needs to be noted that intrinsic value does not guarantee outcomes. It structures your conviction that allows you to act calmly when others react emotionally. Because sound investing is not about proving how many calls you got right. You invest to grow your wealth, not to win conversations, arguments, or table talks. And one important reminder, intrinsic value is not the only determinant of investment decisions. Sound stock selection requires assessing business quality, risk, durability, and capital allocation discipline. Intrinsic value is only one lens in bigger picture. For mutual fund investors, this framework comes built into professional management. Every fund manager evaluates earnings durability, competitive advantage, return on capital, and cash flow sustainability. When When markets fall, fund managers reassess intrinsic value, and if the value thesis remains intact, they accumulate. Did you know that as of 28th February 2026, a share of Berkshire Hathaway Class A costs nearly $753,388 In the early 1960s, when Warren Buffett began buying Berkshire, the share was roughly around $7 or $8 per share. Back then, it was a struggling textile manufacturer. From $7 to nearly $750,000. Now that is not a hype, that is not a speculation, that is intrinsic value compounded over decades. Warren Buffett deliberately chose to never split Class A stock because he wanted long-term owners rather than short-term traders. And that is intrinsic value in action. And that brings us to the market highlights of the fortnight. For the fortnight ending 27th February 2026, the Nifty declined nearly 2%, closing at 25,178 points. The Sensex fell roughly 2.4%, closing at 81,287 points. A 2 to 2.5% of movement within a fortnight sits within typical short-term volatility range for large-cap indices. Concern begins when that accelerates beyond 5 to 6%. Sectorally, IT was the primary drag, while defensives like FMCG and healthcare displayed relative stability. Performance became more concentrated, with fewer sectors contributing positively to index returns. Month to date, foreign institutional investors were net sellers, whereas domestic institutional investors were contributors. The rupee remained near 91 per US dollar, reflecting stronger US dollar. Overall, markets are adjusting to sector-specific pressures and foreign outflows, while domestic liquidity continues to provide the balance. Now that brings us to the wrap-up. But before I go, let me leave you with this thought. Markets will always fluctuate. Liquidity will shift. Sentiment will change. But intrinsic value, when understood deeply, becomes your anchor. When you distinguish between price and value, you stop reacting, you start allocating. And that's where intelligent investing begins.